G'day guys, welcome back. Episode 58, Money in the Tank. Thanks for joining us again, Tankers. It's great to have you with us as we launch into the year with our, I think it's third podcast for the year, and it's great to have you guys back. Two in a row as well. We're on a streak. Hopefully you guys enjoyed our first foray back in last week, and it's good to be back here. We've got some awesome topics today. It's probably going to be a bit of a turbo pod, half an hour of just a lot of different news items, rapid fire items. So anything from some of the stuff going on in America with Jerome Powell, and also crypto with, I think it's Silvergate, the crypto exchange, I believe Brad will touch on.
Yep.
Arnie will have some rapid news fire items. We'll have a bit more on the Fed and also the RBA more locally with the interest rates increase again, another 25 basis point. And then a good 50-50 or great 50-50 that Arnie has got for us, which he hasn't told us about. So great surprise for What's Your Choice, the Savo, and as well as Rivkin's Rules. So without further ado, I'll introduce myself, Joel Seach, Principal Advisor, Harvell FG. Great to be here today.
I'm going to throw to you, Arnie.
Yeah, and it's Arnie, Finance Professional. Thanks for having me.
And Brad, Investor. Thanks for having me.
Last week I said to my left, and you guys gave me crap, so I thought
So you just went open this time? You just went like, I'm just going to see who speaks first?
I just keep going to my left every time, all right? And assume it's Arnie, unless stated otherwise. So getting stuck in today, guys, we've got a bit going on. So this week we had the RBA come out more locally. So 25 basis point rise, which is a 10th in a row, 10th rate rise in a row, which has snuck up on us. I didn't realise we did double figure rate rises in a row, which is a very interesting topical conversation at the moment. It seems to be every time we do a pod, there's something going on in relation to it. So I guess the feedback from that one, some of the information that we captured was the notes or the media coming out afterwards, there's going to be more to come. But then I think Lowe tempered that the next day, RBA Governor Lowe, saying that no, it's going to be a fluid thing, and we're going to review the stats, have things settle, and have things have the data point us in the direction that we want to head. So I don't think they're as set on raising another couple straight away like the media, tend to push the narrative on, but it's more of a wait and see approach, and let's see the data come through. So it's interesting. I think the media is expecting, and the economists are maybe thinking another couple in a row, really. And I think Lowe wants to see the data and the information come through first to make an educated assessment on that. And then as well, as we've spoken about so many times, those fixed loans coming off. And I think there was a Bank West economist came out the other day saying that the banks are already talking about having those fixed loan holders that have started those rates a couple of years ago that are going to come off. They've started talking about helping them through this next challenging 12 months, whether it's mortgage vacations in terms of missing repayments and putting them on the back, topping them up to the end of the loan cycle, or redoing the loan to push the years out and push the repayments out at a lower amount, because they do see a worry with those, especially those new home entrants and those new loan holders that are fixed at that lower rate coming off that. They're a little bit concerned about that. So it's going to be an interesting time to see what unfolds. Thoughts from Arnie on that one?
Yeah, I think, as we've sort of stated previously, I know there's other factors at play here, but in general, I feel like whenever the US raises rates, we are forced to raise rates in lockstep. Now, it may not mean at the exact same pace or at the exact same percentage points, but during the week, the US came out and said, or Jerome Powell came out and said they may need to recalibrate where they thought they would need to get their rates to. Previously, they had sort of said they were sort of around the mark, maybe one or two more raises. Now they're saying they might need to go another 100 basis points higher, up to like 6 to 6.25% range. And the stark reality is, if Australia doesn't keep raising in lockstep with someone like the US, all foreign investment flows to the US instead of Australia. Whereas if we raise, alongside them, then some of that money will be attracted to our shores. So that's just the way it works. And I know there's other factors at play, but that's my thoughts on the matter. So I just feel like more pain ahead.
Yeah. Look, second, when you say only around currency and foreign investment, just nature of interest rates and people putting their money, earning off their money. I do think it's a bit of a backflip because, correct me if I'm wrong, the first words that he actually said the day of it was it may require another 1 or 2 rate rises. And then with pressure, it seemed like, with parliamentary pressure and with media scrutiny, he said, okay, well, we also have the option of taking a pause, right? Like there's some words, and then there was some words about a day later that were a little bit more toned down. The reason why I thought that was the nature of it, because I went back yesterday in a WhatsApp group with a bunch of people speaking. They were all speaking about the rate rise, and then some of them said, "Oh, look, he's saying this now," and I was like, "What? He's saying what?" And there was a bit of kind of furor in the WhatsApp group around people going, "Well, like it seems like the RBA at the end of the day needs to be separate from the government. It has to be a separate institution." The media, it's funny, like the media used to blame Keating in the 80s, but now he's blaming like the central bank for actually doing it, and saying like it's all their fault. And at the end of the day, like inflation does need to get under control. And so I don't know about the flipping flopping and what that does for markets either. Like I think it's been good being quite hawkish to date, but I know it's starting to create some kind of some cracks. What you said there, Jolie, I had some feedback on that, which is I was actually surprised. I haven't done much reading in the last 48 hours, but really surprised if banks start kind of adding on like interest at the end of the term or working with them to try and come up with saving plans and the rest of it, great. But changing the actual underlying structure of the loans is kind of like sometimes gets me a little bit where like if I buy a stock and the stock goes down, unfortunately I don't get kind of anyone coming along going, look, stock's gone down, we'll give you some reprieve on the back end, and maybe if you hold it for a bit longer, I'll give you 5-10% more so you can hold it so you don't have to like get your margin call. And I understand like the size of the problem, and that's probably like them trying to mitigate a bigger overall risk to their own loan books and the rest of it. I just feel like we always bail out homeowners in Australia. Like Australia loves investing in property, and it's like whenever anything comes near taking the steam out of the market, always gets propped back up instead of feeling the pain. So since the 80s,
banks have historically worked with customers around it. They don't necessarily promote, they do, but they do help case by case basis, and whether that's a loan honeymoon if someone loses their job, they prefer to keep the client solvent and ongoing, and whether they tack on months to the end of the loan or refi it onto from a 25 to a 30, which will.
Do you get that with like a margin loan? So if you took out a margin loan, do you get this sort of like you lose your job? Do you get to like?
I don't know enough about the margin loan side of things, but I know the home loan side of things. Yes, I guess margin loans you started to deal with more sophisticated investors, so there's probably more. They are aware and knowing what they're going into with a margin loan, whereas a home loan, it's your mum and dad's buying their home. They've just had a mishap with work and lost a job or whatnot. The banks would generally prepare to work with someone around that and help them get through that.
Which is good, right? I don't disagree, but I always just find it like Australians always just go to property for investments largely. Yeah. And more than any other country in the world, we love using property. But I just feel like it's this like protected animal it's a
cultural thing.
And I don't know if it's healthy though. Like sometimes you have to let the steam out of the market. It's like you can't grow 35% over 2 years and think that's normal.
I think I agree with what you're saying, but I also think that we are seeing steam come out of the market, and the further that they raise rates, the more steam will come out. I take your point. Like you're saying, like at what point do you think someone will step in, like the government?
I personally think this is probably. I reckon we're around about where we need to, because speaking to a bunch of people I know, and they're like, "Cool, I'm paying an extra $1,000 on my mortgage. I've got no more money left." I'm like, that's what their job was. The whole idea was to take the steam out of the market, right?
They have to take money out of the market, and they have to reverse the QE stimulus they did throughout the pandemic. And that's what has to occur. So
I think for the past 12 months, just very generally property-wise in Australia, I think Melbourne's down about 10%, Sydney's about 13%.
Yeah.
I think Adelaide's up around 5%,
yep.
A few percent. Brisbane's down a bit as well. I can't remember how much Brisbane. So, and regionals will be different too. So that there definitely has steam's come out. The issue you'll start seeing is that people are not selling at the moment. They're just the supply side issues. So you're starting to get unnatural supply side pressures when there's less stock on the market. People have to make a choice of shelter and where they want to live. And that'll always come back to property is that hierarchy of needs. People need shelter.
Yeah.
That will always be an underpinning in terms of a property, is that they need somewhere to live, and someone needs somewhere to live. So they're willing to pay for that shelter and peace of mind. So it's an interesting one.
It is interesting. I mean, we've got some house sitters.
You can't sleep in stock unless you're a majority shareholder of someone. Let you sleep in the offices.
Just go down to the Tesla factory and be like, hey, I'm a shareholder. I'm just going to crash here for a few nights. Don't worry about it, right? Hey, yeah.
Maybe MITT might let you sleep there, Brad.
We used to. Harry used to.
I got one more thing to say. Sorry, just on the Philip Lowe stuff. I think you're correct, Brad. There was a narrative in the media, and it said something along the lines of, Governor Lowe says that they might pause in April, which is true. They might pause in April, but that doesn't mean they won't raise, in May. So, yeah, I really feel like his hands are tied a little bit there. I don't know. We'll see how we go.
The only other interesting one on this same topic, is, I don't know if you guys saw this.
Just for the people that aren't watching, Brad.
Oh, yeah. Sorry, everybody that's not watching. It's an article out of the Fin Review, which is Millennials, Not Boomers, to Wear the Pain of Rate Rises. And I found this, I don't know, it's just an interesting perspective. I heard it yesterday, which is basically like the vast majority of people like over the age of 55, like boomers, own their homes. And so the people feeling the rate rises at the moment are generally kind of people in their 30s and 40s. They're the ones that kind of are, the most indebted. And then they're talking about at the moment, like taking the steam out of the economy. At the moment, like all these like 30s and 40-year-olds are paying, an extra $1,000 or $2,000 a month in mortgage payments that are going to banks. And banks at the moment are increasing their spreads. And this is about the golden rate for them to be making lots of money. That's why profits are up and banks are up over the last week. And the article just goes through basically talking about that the rates, where the rates are at the moment, the banks are going to probably be making record profits because they've got the biggest spreads between saving rates and lending rates at the moment, and they're attracting new saving rates in as well. Basically the boomers are going to make a windfall out of the dividends, which are basically people paying the banks for part of their interest rate. So it was a cycles. It was quite an interesting perspective, which is like obviously part of the rates is obviously the RBA, but there's obviously the bit on top of it, which is the banks, and basically through record profits and then via dividends, the people that actually hold, the majority of people that hold banking stocks are in the superannuation and pension portfolios, and the biggest pension and superannuation portfolios are that of the boomers. They went into all the details on that. Quite an interesting article. Just thought I would throw it out there.
Playing devil's advocate, if you can just share your screen again, Brad, for that article at the top of it. The millennial side of things is, don't forget the listeners out there, especially the younger ones, with your super, you will have generally these financial stocks and banks inside of your super. So you will be getting a value out of that, just the top of the article, Brad. So you'll be getting value out of that in terms of, any, market movement in bank upside, and banks are getting their spreads at the moment better because when the rates go up, they've got more spread to be able to squeeze from, deposits into lending out. So that'll definitely, so those millennials out there, know that your super is invested as long as it's in the right area, for sure. And then the second thing on that article, Brad, that I was just going to mention the gentleman that wrote it on the Financial Review there is John Kehoe. I always find it interesting why they look surprised when they're getting their profile picture done. I'm surprised that AFR have taken a photo of me for my story. Anyway,
what do you know?
That's
there's a bunch of actual artists out. There's a bit of an analysis as well, Jolly, about just the percentage of holdings. So they looked at basically the size of superannuation accounts across age groups, and then what holds. Yep. So your point's 100%, but it was funny that perspective.
Get there, the pre-retirees and retirees are because of compounding. They're the larger holders now, but the millennials will get there. They'll compound over time, and as long as their investments and their super in the right area, that'll compound and work for them over time. And you're right, we deal a lot, with my business with pre-retirees and retirees, and a lot of the debts are clear. We do have a wealth accumulators for sure, and there's more talk around loans and investment loans and that sort of thing. But yeah, your pre-retirees and retirees generally, it doesn't come up that often because they sort of have almost forgotten about loans. Like it's like, tough for the kids. or tough for the grandkids, or tough for the grandkids to get in the property market. How can we help them? How can we sort of help, make it work for them and help the grandkids out with getting a foot in the door, help the kids out while they need it most? They talk back to remembering around the 80s as to, the retiree clients are talking the 80s when their rates were 17, 18%.
17, 18. My mum was talking to me about it the other day. I was like, oh.
Yeah, different era, different time. It won't ever get there again. And I guess the inflation side of things.
Like it never, Joel. Glass half full. I like it.
If you think about like a grass fire, is the RBA at the moment are trying to quell that grass fire and contain it, put the containment lines around so it doesn't spread. If a grass fire or a forest fire spreads, it starts to become harder and harder to contain. So think about wage creep, inflation, that sort of thing. They don't want it to ingrain and spread. They're trying to put all the water and the ammo on it right now so that come 2024, they can start to look at cutting, and they probably will. They'll start looking at cutting because they'll see the economy's slowed down enough. People are under strain, and they don't want that to occur. So they just want to stop the spread now.
They don't want a Volcker 2.0, right? Which is like he came in after 10 years of inflation. It was like, let's turn it up. Arnie, any last thoughts before we jump on the banks?
Just that I think that Fed Chair Powell in America sees himself as Volcker 2.0. But
we missed the boat.
Before we do jump on the banks, I don't know if Jolie wanted to carry on his chat about super, and I can recuse myself if you want to talk about that now, Joel, or you tell me. I'll recuse myself if I need to.
Yeah, sure. So we can touch on the super side of things just briefly. So last week, the current government came out with a $3 million cap in terms of superannuation holdings above the $3 million mark would be taxed at a higher rate of taxation. So currently, the superannuation environment is taxed at up to 15% on earnings. In pension phase, it's 0, and capital gains is a lesser amount. Anything, the interesting thing with this new stat there, or this new thing they're trying to bring in 2025, 26, I believe, is anything above the $3 million mark, they're looking at adding an increased percentage tax of 15% top. Yeah, so it's essentially, and look, they're getting away, I think, with not being thrown over the coals by the media because it's impacting 0.5% of people currently.
I heard 80,000 was the number I heard.
People in Australia. So it's really the wealthy at the moment. But interestingly, they haven't put indexation on the $3 million mark. So that will start bringing more and more people creeping into that area. Especially
with inflation at 7%.
Yeah, so that's yet to see what happens there. They just haven't mentioned that. So that's interesting. There's a calculation, a formula around it. So it's they sort of work on account balances at certain time of the financial year, and then they add the earnings onto that, and they do a percentage allocation as to what they're going to tax that portion by in terms of what's attributing to that amount that's going over the $3 million mark.
So you're saying today that if you had a super balance of $3 million, you don't put any more money into it, but let's just say that the dividend income that year was, let's just call it 10%. Well, so you've got an extra $300K coming in from dividends. Are they going to tax that at 30% as well?
It's going to be, so think of it as 15 above the normal 15. So it's sort of separating the two. So
gotcha.
the taxation would be on the portion of earnings at when you work out the formula and the percentage. And we can share screen next week, and I can go through how the formula works for those that are interested, because it is interesting. But the interesting, the thing that you mentioned there, Brad, which just jogged my memory about it, is it's actually, there's a potential issue there with clunkier assets like property. You're essentially going to have to pay tax on unrealized capital gains if a property value goes up and your
very dangerous
goes up. So you're starting to bring in something where the person hasn't got any more liquid money that's come in, but they've just had an inflation of their capital value of their fund or their pool of funds, and they're making that's a tax event, which normally, for the listeners out there, if you have something that grows in value and you haven't sold it down, you're not realizing that capital gain. So there's no tax to pay until a future date as to when you do liquidate it or sell it.
And the risk there is you pay tax on something that you may actually eventually have a loss on. That can happen, right? So if you've got a property and also you don't have the liquid cash to pay so you have to sell it down to actually sometimes pay for. Correct.
That's where the difference of dividends and interest and whatnot. you've got that money that's come in, so it's earnings that it's disposable or it's liquid, so you know that you can set that aside. So there'll be more to come on that one, but it seems to have been like this is what's going to happen, and we'll wait and see. But it'll be for the next election. So that's their proposal. Because I think they said in their election promise that they didn't want to make any changes to super, so they're not breaking that because this would fall into the next term if the Labor government gets re-elected. So we'll keep an eye on that, and happy to go through the formula with anyone that's interested next week potentially. But
Put down in the comments if you're interested. If you're heading towards that $3 million and you want a bit more information.
Yeah, look, it's still an attractive area. It's still, the superannuation environment is set up to help fund retirement and help have a tax-effective area for funds and money. And essentially, like obviously general in nature and education purposes only for this podcast, but you can have different investments in different areas, and depending on how you've set it up, super is just one of those structures where you've got your money invested, then you've got your individual names, and you've got investment trusts, and you've got other different structures where you can have money and assets invested in, and it's just how you're structuring that. But yeah, seek your personal financial advice for your own personal situation or taxation advice when it comes to those things. But the government will always tinker. They'll always tinker with super. The one thing we can guarantee is they'll always adjust it, but it's still a very
when the pot's that big, they can't help themselves.
They can't help themselves, but it's still a very tax effective and a positive vehicle to help partially fund retirement.
Did you last comment? Did you hear what the Greens came out with their asking what the amount they were asking to cap it at?
I believe it was a very small amount.
Well, 1.9 compared to 3.
Yeah. So that's it. Yeah, that's interesting. So yeah, currently there's without the pension amount is going to go to 1.9. You can have it a pension phase for retirement, which is a tax-free space. So maybe they've grabbed the number from that. I'm not sure. But anyway, we'll see.
Anyway,
guys.
Bring back Arnie.
Very topical, and bring Arnie back.
Hey, buddy.
Good to chat. Good to have you back, Arns. And I will save Rivkins for the end of the episode today because I forgot him at the start. So we'll pop him in just before 50-50. So audience and tankers, stay tuned for that.
Nice. Just want to talk about quickly two banks, completely different sort of banks to your traditional banks that are in a bit of trouble in the US. It's something to kind of just be aware of. So first one is throwing it up for those on the listening to us on the pod. So Silvergate Capital goes into liquidation weeks after the stock plunge. So Silvergate is a bank traditional like 1987 was, has more and more delved into the digital asset space and got into crypto pretty hardcore. So the firm lent out most of its funds to crypto exchanges and got hit pretty hard out of the $32 billion FTX crumbling. Obviously, you've got Elizabeth Warren out there who hates crypto and everything to do with it and has been relishing in exchanges crashing. And now, her comment is Silvergate's bank's failure is disappointing me but predictable. I warned Silvergate's risky, if not illegal, activity and identified severe due diligence failures. So this is one to watch because obviously the stock's down 97% from all-time high, 67% this year.
So Brad, for the layman's out there listening that aren't fully invested or understand the crypto or the banking side of things, Silvergate essentially took borrowers' monies like a normal bank would do, and they're either lending that out, but they've essentially lent that money out to FTX.
So what they were like a traditional bank, but they were a bank that you could hold crypto with. They also were a bank that did a lot of kind of financial like synthetics and securitization of crypto. So if you had a lot of crypto, they'll then lend you out fiat against your crypto and hold it. And what they also did was lend out their crypto holdings because they took those deposits. They also lend those out to kind of exchanges and the rest of it around, some of their synthetic products, some of their margin products, and also, so they're getting kind of like paid, quite handsomely for providing kind of liquidity in crypto to exchanges to then lend on. And so when the exchanges went under, when Celsius went under as lenders, when all this sort of stuff, a lot of the crypto that they had lent out suddenly wasn't there. So then the people that had deposited with them, they didn't have their deposits left, so they've had to cover that. They'll make it.
Uh-oh.
Sorry, yeah.
They said, uh-oh.
Yeah, they said, uh-oh. And so they were a bank though. So like as in, I guess they'll use more for traditional and for crypto, but it looks like it's put the whole bank kind of at a bit of risk. And they're going to voluntary.
Are they gone for, were they insolvent now, bankrupt?
Yeah, voluntary liquidation.
Yeah.
So before I jump on to SVB, Arnie, Jolly, any thoughts?
I've asked mine.
Yeah, I guess my thoughts on this matter are I guess the whole crypto sector right now is pretty bleak for a number of reasons. I still see utility here. I feel like we're going to see more pain in this sector, and I don't know what the final iteration of crypto will be, but I guess I just think it's one of these things where this is a risk asset, and if you are like, this is general in nature, not financial advice, but with risk assets, generally you should have, keep your allocations relatively small compared to the rest of your portfolio, because there could still be tremendous upside in crypto. That's the way I view it. So I also wonder who will be the last sort of players standing, and who will benefit from this the most. Everyone's talking about Binance. Everyone's talking about Coinbase. So yeah, we'll see how that goes.
I think good commentary. I think Coinbase, Kraken, Binance, obviously Binance being the biggest, are all going to be probably players in the exchange kind of side of things. I think crypto, I'm still working on a number of projects, like rather than investing, I'm working kind of with Hedera Network on their $750 million with Google, Microsoft, Oracle, etc., their ESG platform that they're putting together at the moment to do carbon trading and the rest of it. So there are, you've got kind of, Cardano and a bunch of others teaming up with, say, the launch of the Indian central bank digital coin. You had RBA just announced last week, I think it was. Correct me if I'm wrong. Jolly, do you know about that? The RBA digital currency release.
I was going to say, do you want to bring us back to full screen, Brad, or are you still sharing stuff?
Still sharing. I was going to go. So the RBA have just released. They're doing 9 digital currency projects, CBDCs.
And the RBA have historically been a very, very conservative reserve central bank. So, I remember a couple of years ago, I haven't heard much from it since. Yeah, they go bring up CBA.
But this is going to be with the RBA. So the announcement with the RBA basically came out on 2nd of March. So what's that, a week ago? Saying that
it's running hot, Brad, a year and a bit ago, the banks were starting to come out and say, how do we get part of this? And we can offer this trading platform where you can buy stuff through your online banking. And they're very, they've gone quiet on it. So it's interesting. I was wondering where they're at with it all. And
it's still moving. So the thing is, it's just probably not getting as much media attention like this, right? So the RBA's come out, for those, again, that can't see this. Basically, RBA's come out and they've picked, the ANZ, Unison, Minova, Canvas Digital, CBA, MasterCard, etc., for 14 different use cases for crypto, from offline payments to superstream payments to GST automation to CBDC, so central bank digital currency custodial models, funds custody, tokenization. So a whole bunch of, different use cases with different companies in Australia, and they're going to be working with these 14 use cases, utilizing the RBA's Australian new digital currency in here. So stuff's moving forward. Definitely, it's just, I'd probably say, isn't garnering as much media attention because there isn't the hype around, the readership around crypto at the moment, because probably most people are in the red. But
all right, on to rapid fire news, and then I've got
sounds good.
50-50 for you both. And just at this point, if you're still with us, please give us a like, comment, subscribe. You can follow Money in the Tank at YouTube, Instagram, Twitter, and Facebook. So the rapid fire news. So Leisman on CNBC has said that a systemic risk event could force the US Fed to stop hiking rates. Chinese oil consumption expected to peak around 2030. Biden has proposed a 6.8 trillion budget for 2024, which would add 1.8 trillion dollars into the next year's deficit for the USA, but also has proposed a 5.5 trillion tax increase over a decade. And I'll get to a summary of the Biden administration proposed tax changes in a moment. Raimondo, US wants bigger India role in electronic supply chain. Same source, US India to sign semiconductor memorandum pact. Okay. So the summary of Biden's tax changes, I actually got this from Twitter, but I don't have the account, so I can't credit it. Sorry. But they want to raise capital gains tax from 20% to 39.6%, the highest in America since 1978. The top tax rate over there will be raised from 37% to 39.6%. Corporate tax rate raised from 21% to 28%. Self-employment tax raised from 3.8% to 5%. They want to increase IRS funding by 15% on top of the $80 billion from the Inflation Reduction Act. 25% minimum tax rate on households with 100 million plus net worth. Elimination of tax break for crypto investors. Elimination of carried interest tax break, and increase the stock buyback tax from 1% to 4%. So these are all proposed, not necessarily going to get approved or go through. And I want to get your thoughts on that, boys. And then I've got one more news item after that. So I'll go to Brad
I
first.
will give this a near 0% chance of any of that getting in. So with 2024 election campaign starting, Trump coming in again, possibly being at least the nominated, being at least the nominated preferred for the Republicans after CPAC, either him or DeSantis, who's number 2 really, but hasn't actually said he's going in the running. I doubt very much that they're going to be running against this, which is everyone knows, they're already running on the economy, and everyone knows that even though it says low unemployment, that basically there is a huge problem in the US with the economy, and that if they raise, CGT, it's going to lower investments. There's no way they'll get the 1 to 4% on people over $100 million just because of the way that money is in politics over there. It costs. I think DeSantis raised $125 million just for the governor race in 2 months. It's a couple of $1 billion for a presidential race at the moment, and they usually, the big super PACs and stuff get in there. So, I mean, me living in the US for 4 and a bit years and seeing stuff get put up, I just don't see it happening. I mean, there's only cuts that occur over there because the lobbyists will let cuts happen. The lobbyists won't let kind of broad-ranging tax increases happen. But I mean, America is at the end of the day, I mean, they still do add ridiculous amounts of debt, but being a reserve currency kind of gives them a little bit of free will to do it. So interestingly, China's obviously been selling down record amount. I think it was $887 million worth of bonds. So another $1 billion worth of bonds recently. You got Japan and China selling down a lot of the bonds. Look, as long as American currency is reserved, I don't see America changing up. That's my summary. Jolly?
Yeah, I'll just while you were chatting on the tax side of things, I just Googled for anyone of interest the usdebtclock.org. A lot of numbers and a lot of figures that are just moving every second. So the US national debt, 31,605,404 million. And it's just going up every second. Interestingly, the US federal debt to GDP ratio in the 60s, 53%. In the 80s, it was 34% of debt to GDP, gross domestic product. In 2000, it was 58%, and now it's 120% debt to GDP.
Yep.
So, does something have to change? Maybe. Do they just, as you said, they're the reserve? Do they print more money? What do they do?
It actually, sorry to cut you off, it actually depends on how you measure that last metric, because the White House themselves have come out and said that the debt to GDP metric is currently at 97%. However, the Biden administration is saying that in conjunction with this, they are forecasting debt to GDP to go to 110% over the next.
And what sort of debt you include? But I mean, using the traditional kind of like country's government debt versus gross domestic products. I mean, Australia's sitting at 58% for the tankers out there, just as a bit of a
He's
Yeah.
he's the
No,
clock one of it.
well, no, America's national. So, the United States government debt accounted for 123.4% of the country's nominal GDP in December 2022. So it is up. It is up to that. I think Biden is just saying that some of it isn't debt and the rest of it, but like
the White House measures things how they want to measure things.
Yeah, exactly, mate, 100%. Because even when you go to like whether it's you go to Stanford or Seek data or trade economics or physical data, everything is saying about 123%. So
people say China make up the numbers, but so you can go to the debt clock and you can have a bit of a look around. You can hover over items, it gives you the information, and then you can see here interest on debt, net interest, debt, US Treasury notes, bonds. I guess that's per annum, 541 bill. So there you go.
I think the funniest part is when you're on 6th Avenue in Manhattan, they've actually got the debt clock
That's
live
right.
on the side of it's live on the side of a building.
Yeah, I wasn't sure where it was.
Yep.
Yeah.
That's an impressive clock. But so the last news item, because no rapid fire news would be complete without mention of Elon Musk or Tesla. You might have seen on Twitter during the week, boys, that Elon had a very public interaction with a Twitter employee, perhaps former Twitter employee. I'm not sure of the status at the moment, where this employee had to tweet out at Elon Musk and try and get it to go viral because he said he'd had his computer access cut off at Twitter for like 9 days or so. And then this exchange unfolded where Elon sort of said, what's going on? What have you been doing? Yeah, break confidentiality. Tell us what work you've been doing. Yeah, this is the bloke. I am Geraldo. So if you want to look at him, people, and you're not watching the stream, you can go to Halli, Halli on Twitter. And you scroll down, you'll find this interaction. But then essentially, Elon said, you haven't been doing any work. He said it to another user, said, this guy doesn't do any work at all. And then it came out that this fellow has muscular dystrophy because one of the allegations was that he hadn't been doing anything physical. And then this guy's come back and said, yeah, that's right, because I've got muscular dystrophy and I can only do very limited physical work. But it turns out that this fellow, I think before Elon Musk took over, sold his business to Twitter and wrote into the contract a stipulation that if he were to ever be fired before a certain term, that Twitter would have to pay out X amount of value that he, had previously valued his company at. And someone was saying it's in the ballpark of around $100 million.
Good on him. I love it.
And then, like magic after that, and the $100 million figure being thrown around and the muscular dystrophy, Elon Musk sort of said, he sort of came back and apologized and said, I've had a discussion with Halli on the phone, much better than tweeting at each other. And I apologized to him formally, and he's considering remaining at Twitter. So I don't know. I feel like Elon Musk has put his foot in it a bit there, which he does quite often. Thoughts, boys?
Two thoughts.
One, did he sack someone live on the Joe Rogan podcast one time? I saw maybe a few years ago. I remember him on some kind of talk show or something, and something went wrong and he fired someone. I don't know if that was all made up, or I'd have to recheck it again. I have to fact check myself.
Not sure on that one.
Yeah, obviously town hall isn't the best place to discuss everything. Sometimes the phone is the best place to discuss stuff. I think the backtracking is only because obviously the blowback, but Musk finding out about how he built into his contract wages rather the purchase price will be paid in wages rather than the lump sum amount, and then the breaching fee. Because at some point Twitter was buying. This is maybe, I don't know, I'm going to go say 10 years ago, just like Facebook. Everyone was buying everything, right? They're just buying everything. And these sales contracts have been long forgotten now. And the people that probably are in the legal department of Twitter probably been fired anyway. So, look, it's just another example, I think, of Elon just loving limelight. And this guy actually reading him like a book and being like, sending out the fishing rod. And because the guy was like, enough likes and Elon will reply to this. The guy had it totally set up, I reckon. I reckon the guy's quite smart. If he kind of is trying to get around the tax laws over in Iceland by making the sales contract in wages and the rest of it, I reckon at the same time, he's like, if I have a public spat, Elon can't help himself. He'll get involved. And, I might be able to get some more money. I reckon the guy's just intelligent and reading Elon like a fucking, like a poker player should.
I love it. So thanks for the rapid fire news items today, Arnie, and bringing up Elon and keeping the listeners, giving them what they want. keeping it consistent. Go without. And I did see that Elon's stock price dropped 5% last night because of a fatal crash with a fire truck, maybe from a month ago. I don't know if it was a self-driving car, that one, but I think there'll be constant news to come on Tesla. So we'll be able to keep giving the listeners what they want and keep Arnie chatting about his mate Elon.
Keep rapid fire news in business. Yeah,
absolutely.
So the 50-50 this week, boys.
Get to your 50-50. We can't go through an episode without Riv, and I forgot to throw him up at the start. So
big Riv dog, get him on.
Let's quickly have a look. I'm not afraid of death, only the pain that might come with it. No idea what that means, but I guess what is that under? What topic is that under? That's Renee on life.
That's kind of like Packer about like, do you want the good news or the bad news? And he's like, the good news is no hell, the bad news is no heaven. That's similar. Yeah.
Irrelevant Ripken this week. So on to Arndog's 50-50.
50-50, boys. So you might have seen the massive news during the week that beloved Victoria Bitter is releasing VBXL or VVX or something. It's extra strength. It's 6% stubbies, right? Dubbed by some the Red Rocket. And that made me ponder, in famous Australian beer, if you were forced to choose between a Victor Bravo, VB, Green Goblin, or a Melbourne bitter, both from Carlton United Breweries, which one would you be choosing?
I'd say it's a tough one, Arnie, because I don't like either. But if I was to have to choose, I feel I'd go with a Melbourne bitter, just to be that little bit more unique and that little bit more hipster. But maybe it's gone too far now. It's not as unique anymore to have a Melbourne bitter because too many people were doing it. But I really don't like VB. So I don't love Melbourne bitter, but Melbourne bitter it is.
Rattles?
I'm just Melbourne bitter is probably the only thing that could go down my throat. I'm not a Carlton Brewery kind of guy. So
no love for the CUB staples. Well, I like both of them, but I am also partial to a Melbourne bitter. And
what is the Green Goblin?
The Green Goblin. They've got many nicknames. The Vomit Bomb.
Oh, Vomit Bomb. Yes, I know that.
The grenades. Sometimes they're called. The green color scheme is very popular. But yeah, Melbourne bitter.
Now, Crownies. Do Crownies still fit in there, or are they not around anymore?
Yeah, Crownies are still around. All the staples from CUB are still
I call them
there,
the box beer. They used to be in all the boxes at the football.
Yeah, maybe they got a contract or something. But I think
you don't see Crownies at bottle shops anymore, but you just see them at functions. There's all these function places in Melbourne and Australia have this long lost stash of Crownies when they used to be popular, and they bring them out for events. Otherwise, I'd never see Crownies anywhere else.
I mean, I haven't actively looked for them, but I feel like I wouldn't have any trouble finding a box of Crownies if I, slab of Crownies if I need them. But yeah, I'd go with Melbourne bitter. And to your point, Jolie, I feel like I liked Melbourne bitter before it became the hipster's drink of choice, and now that it's fallen out of favour, I still like Melbourne bitter. But I'll try a Red Rocket if I come across the extra strong 6%ers. Yeah, I'll try that.
There you go. What would you do, Tankers? What would you do?
50-50. Yeah, we want to hear from the Tankers. Great 50-50 this week, Arnie. Thanks for that. And where can the listeners or where can people get us at with questions when they want to interact with us and give us subject matter or 50-50s, Arnie?
Yeah, please get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook. I would love to hear the support or the for or against, for CUB beers, whether you like partial to a Victor Bravo or a Melbourne bitter. Let me know. But yeah.
We look forward to catching up with everyone next week once we get back into Money in the Tank, which will be episode 59 on our way to the ton, the 100, the 3 figures. We're getting there slowly but surely. It's been a slow start to the year, but we're on track and we're firing on all cylinders now. So Tankers, stick with us. Keep bringing those questions in, bringing those topics in, and we'll keep answering them and having a great time as we progress with it. General in nature, educational purposes, as always. Thanks for that. Have a great week.
See ya.
See ya.